Hi, today we're talking with Jim Miller from IPX at 1031. Thank you, Jim, for taking time out of your busy schedule to talk about a hidden jewel that we have out there, and that is a 1031 tax exchange. Can you tell us a little bit about that?
Basically, 1031, the actual concept started way back in 1918. Section 1031 per se was in the 1954 code. The Treasury Department passed regulations in 1991 and basically said if you want to do a 1031 exchange, do it this way. If you do it, as long as you do it per their regulations, they have given us a safe harbor. Essentially, they say, well, we'll leave you alone in an audit. You just have to do it a certain way. Basically, and the concept is I'm selling one piece of investment property and I'm buying another piece of investment property. So I've got X dollars tied up in one property. I move that to anywhere in the country, and I buy, as long as I buy equal or greater in value, in other words, I fully reinvest, I can fully defer the taxes. So I'm just taking, I've got X dollars tied up in this investment property. I sell it, and I take those X dollars and apply it to another property. And if I do that, it's full tax deferral.
Funny you mentioned property outside the state. Yesterday I was talking to a new client, and he inherited a property in Ohio about 10 years ago. He said today the value is about $500,000, but he's got a line of credit of 150, something like that. So his thought was sell the property. He thinks he would net out about $350,000 after he pays off the line of credit. Then he wants to bring that money into Phoenix and start buying some investment property. Good decision, or 1031 better?
1031 would be a lot better. Unfortunately, his concept seems right, but he's forgetting one key thing. He's going to pay tax on the gain. Now, he inherited the property, so his basis, and he's owned it for about 10 years, so his basis would have been the value of the property the day that he inherited it. That's what his tax basis is. 10 years is a fair amount of time. There's going to be some appreciation, so he's going to pay some gain on that. Generally speaking, you've got 3 layers of federal taxes. You've got capital gains, which, you've got the capital gain rate currently is 15 to 20%, depending on somebody's taxable income. You've got depreciation recapture tax of 25%, so any depreciation that was taken, which is mandatory, is taxed, or it's basically what you did take or what is allowable. You're going to pay 25% on that. Plus you've got the 3.8% affordable health care surcharge on capital gains, and that's on the excess above $250,000 of your adjusted gross income. In addition, 41 of the 50 states have state taxes. So generally speaking, we usually figure if somebody sells, pays the taxes, and reinvests in that equity, they're going to send somewhere between 20 to 30% of their gain away in the form of taxes. So he would not be coming to Phoenix with $350,000. He'd be coming to Phoenix with less than that.
Well, that's huge. So what would he have to do? How would he get started with you? What's the process?
Well, basically, the most important thing is that someone has to have the 1031 exchange set up before the old property sells, the relinquished property, the one that they're selling. It has to be set up. And by set up, I mean they have to enter into an exchange agreement with a company like IPX 1031, a qualified intermediary, and we assign into the contracts. Frequently, and this happens unfortunately way too often, there's a lot of times people think that setting up an exchange is kind of like setting up a special bank account. So they'll do this. We'll get a phone call on Monday morning and somebody says, hey Jim, I sold my investment property. On Friday, I'd like to do an exchange. Or, I sold my property, I'd like to do an exchange. And my first question is, how do you define sold? Some people define sold as I put it under contract. Good answer. Some people define sold as, I closed escrow last Friday. That's a bad answer. then they have a taxable event. So basically, you've got to set up the exchange, the qualified intermediary, you enter into the exchange agreement with the QI, the qualified intermediary assigns into that contract, and the net sales proceeds, instead of going to the seller, go to us, and we hold on to those proceeds. Then they find their replacement property, their new investment property, enter into a contract to purchase it on X date for X amount of money. We assign into that contract, and we are able to, since we're assigned into it, we're party to the transaction, we're able to move the money over to that transaction. And we tell the seller of the new investment property, the replacement property, to deed directly to the exchanger, and that completes the exchange.
So I know when we talked a couple of weeks ago, we talked about like scenarios. So in this scenario, he has a house worth $500,000, and he's also got debt. So does he have to keep the debt structure the same?
Okay, what is necessary in order to have a fully tax-deferred exchange? We talk about the napkin test. There's 3 requirements to have a fully tax-deferred exchange. That's where I'm not going to pay anything in taxes in the year that I do the exchange. So I want to buy equal or greater in value. Whatever debt I had, I want to replace the value of the debt. So he's got $150,000 debt. He would need to replace the value. He could do it by getting a $150,000 loan on a combination of all the properties he acquires in Phoenix. He could come in with $150,000 in cash from outside of the exchange, or a combination of both. He just has to replace that value. And the other thing, the other third component, is the equity. Any of the net proceeds he has to fully reinvest. So if he buys equal or up in value, spends all of his equity, replaces the value of his debt, he would have a fully tax-deferred exchange.
Can he increase his debt structure, leveraging a little bit more?
He can, if he's buying higher in value.
Right. So he now buys, let's say, 3 properties, total of $600,000, $700,000, but it increases his loan from $150,000 to $200,000. He's good.
Absolutely. The most important thing, or the two most important, are buying equal or greater in value and spending all of your equity. Because if you think about it, if I do both of those, mathematics is going to take over and satisfy that debt requirement.
I like the napkin test. I'd have to have a beer with you someday. Quick question. So there's some time frames. There's a 45-day period and there's a 180-day period. What are those?
Yeah. From everything starts from the date that the old property is transferred, and the service talks about the transfer of the benefits and burdens of ownership. Okay, so that's the transfer. Most of the time, you can shortcut it and say it's the close of escrow. It's when you close. It's when it's transferred. That's day 0. Day 1 is the next day. Then the exchanger has 45 calendar days, not business days, calendar days, includes weekends and holidays, to identify the replacement property. And you can identify 1, 2, or 3 properties without regard to their fair market value. You could identify any number of replacement properties under the 200% rule, but the catch is that the total, the aggregate value of everything that you've identified does not exceed 2 times or 200% of the value of what you sold. Okay? Then you've identified the property, then you have the remainder of 180 days, so 135 more days to acquire it, to take possession, to get the benefits and burdens of ownership of that property. So it's a total of 180 days. Everything starts from the transfer.
What happens in that period of time? You've identified a property, and for whatever reason, in a 45-day period, it falls through.
Okay. During the 45-day period, the exchanger is free to make and revoke identification. So as long as we're within that 45-day period, if something happens to the property they want to buy, they can revoke that identification and substitute something else. If we're outside of the day 45, so let's say day 50, and they've identified 3 properties, one of them they really want, and something happens to that property that they no longer want to buy it on day 50, they're going to have to rely on their backups, because you can't change it. Once you get out, once you get outside of the 45 days, that's it. It's carved in stone.
So you recommend identify multiple properties in the event that the ideal property falls through, you now have some backups in there.
In addition, I usually suggest that somebody completes the due diligence within the 45 days. So if they find something that's a problem with that property, they can revoke it and substitute it with something else before the end of the 45-day period.
Yeah, one of the things that we do differently than anyone else is we have this 10-day inspection period written into the contract, so that due diligence would involve, because we're talking about an investment property, not only an inspection of the property, which is known as a Benzer, but also getting with the property manager to identify what the rents are to make sure that this is going to be a cash flowing property. So, but still, we have to get this done in 45 days.
That's very good to be doing it, be thinking about that and doing that.
So with tax planning and tax shelters, how expensive is a 1031 tax exchange?
It's not a tax shelter.
Okay.
It basically you're not avoiding taxes. It's tax deferral.
Okay.
Okay. And that's one of the things that's sometimes in the media, and they're incorrect. They don't understand the concept, because we're not taxing cash flow. We're taxing when somebody cashes out or partially cashes out, they're going to pay taxes. It will vary. Generally speaking, most qualified intermediaries don't, it's typically a fee, and the company that I work for, we're nationwide, and so as most things in different parts of the country, they cost differently, different amounts. In Arizona, the fee is $850, and that includes one relinquished property and one replacement property. There's additional properties, and then there's $250 per additional property. That's what our fee structure is.
It's a lot cheaper than 30% of 350, which
Absolutely.
We're talking 90,000 plus. So that's pretty economical for just doing a 1031 tax exchange. And finally, the gentleman I was talking to yesterday, the client, is in his 60s, and the question finally came up: what happens if he's in his 80s and there's a medical need? Can he get at this money that has been in the tax exchange?
Absolutely.
How would he do that?
Well, he would just tap in with a line of credit or cash out refinance.
Okay, perfect.
And if he needed to sell it, he could sell it, and there's not going to be any penalties later on. He's just going to pay taxes on the difference between the sales price and his tax basis at whatever tax rates are in the future.
Okay, that's great. Again, Jim, thank you for your time. If any of our viewers wanted to get a hold of you, what's the best way to contact you?
My telephone number my direct line is area code 602-850-8630, and our website is www.ipx1031.com, and that has a library of information about 1031 exchanges, as well as all of our locations nationwide.
And that's a great point. Jim brings up about the library. I've been on it, and there's just a wealth of information on there. So, anyways, Jim, thank you. Don't want to take any more of your time. Appreciate it.
Thank you.
Thanks.